welcome to Money Matters. My name is Jim Butler with Marcum Wealth, and my co-host in this show is Mike Dever from Brandywine Asset Management. Welcome, Michael.
Hey, Jim. How you doing?
Good.
Good. Great.
Well, as we know all too well, we don't like to date ourselves for any of our shows. However, this one is historic. Historic only in that it's early November and it's on the other side of the election, not on the pre-election path. So let's chat for a few minutes about that, more in a general sense, just in terms of what not so much what might happen, but what we might be looking at in the weeks and months ahead. So what thoughts do you have with regards to, anything from an economic standpoint?
It's pretty interesting, and because it's a sweep of Congress as well by the Republicans. So you've got Donald Trump as president. You've got the Senate with what looks like a reasonable cushion, and then the House looks like it's going to be going Republican as well. You have the ability for some of these policies that they've been talking about over the last year and through the campaign to actually take place. And one of those out of the gate is lower taxes. And part of the problem was that at the end of next year, 2025, the taxes that were put in place in Trump's last administration were expiring. And so those are almost certain to get extended. But he's also talking about lowering the corporate tax rate even more, which is opposite what the Democrats wanted to do if they came in, to potentially even 15%, which would be really unprecedented for the United States, for decades. It's interesting because both of those policies will be, they'll be probably inflationary, but also growth policies. They should both foster economic growth.
So that raises a question with regards to how is it going to get paid for? Because there's less revenue coming into the federal government, and given the budget that's in place and the entitlements that are in place, there's commitments with a lot of money going out. Do you think investors should be concerned with how do these potentials get paid for?
Yeah, there will be repercussions. I mean, first of all, yes, there could be some growth. I say yes, you didn't ask a question, but there could be some growth that stimulates even higher tax revenues based on current tax levels. Unlikely, certainly in the near term, to offset the tax reductions that they're talking about. The corporate tax reduction won't do a whole lot, but my guess is that they push on the individual, the personal side as well. And so, yeah, that is something that could be deficit increasing. So what they also have is Elon Musk. And coming in as the efficiency czar, or whatever you might call him, Musk has publicly stated that he can reduce the spending by 1/3. Now, I don't know how he's going to do that, because Trump has also said he's not going to touch the third rail. He's not going to touch the entitlements, Social Security, Medicare, Medicaid, and those make up a couple, 2/3 with interest of the budget all by itself. So it's going to be really difficult to cut everything else out, or to cut even what they said they're not going to cut. So I'm not sure what's going to get cut, but there will be some cuts. Potentially, if they really do go in there and they start dismantling the administrative state, which means organizations, associations, administrations like the SEC or Department of Labor, or some of the environmental departments, you're going to see people on the street, which is going to raise unemployment. But at the same time, they're also talking about border policy, deporting people, which will cause a severe shortage of workers and personnel. So it's going to be an interesting combination. I don't think there's any way that they're going to find ways to cut enough, though, to offset whatever they're probably going to do on the tax side for cutting taxes.
Right. And with regards to being able to pay for everything, and through the reductions that you mentioned, like regulation, uh, there's some certain talking points in there from Musk or Trump. Being able to get all of those in place anytime soon is certainly going to take some time. And even even with the Republican sweep, I think they most likely need to be very careful that they don't go too far and cause things to spiral out of control, such as inflation or even unemployment. If you combine a lot of those aspects together, as far as higher inflation, because goods cost much more. We haven't even touched on tariffs yet. They are likely coming at some level. And as far as deportation is concerned, that could reduce the labor pool. But you know, there might be if there's a silver lining for our Democratic colleagues, it might be that um, Trump only has 4 years or less. So he's not a two-term president. He only has a certain amount of time to get something done. And you could even argue that the midterms coming up in 2 short years kind of puts a little bit of onus on them to really prioritize the things that they can make progress with.
Yeah, normally I would agree that things are going to take time, but they do only have 2 years, I think, in their minds. Who knows what happens in the midterms? Usually, you lose seats, the ruling party, and then. But Musk has a track record. He's not afraid of just destroying a business to get it to where he wants it to be. I mean, X, Twitter, he took out 80% of the staff. And he didn't have a problem taking out 10% of Tesla last year. He hired some of those back, but he'll cut to the bone, and it might be near its deathbed. But I think Trump is going to go along with that. And I think Congress is going to go along with that. And I think it has the potential going beyond 4 years, because the Republican Party has changed. I mean, it's not what it was when Reagan was president. I mean, or even Bush. It's so different now that people are accepting sort of these more radical approaches to things. So I think you're risking recession. Not that that's bad. If at the other side of it, everything's better. You're risking absolutely, almost certainly, you're going to have inflation. Deporting people, tariffs are by definition in inflation. You're just raising the price of something. So you're almost certainly going to interfere with the Fed's plan to be lowering interest rates, because their dual mandate of full employment and 2% inflation, they're going to start struggling with that. It's been easy in a way for them up till now. They had enough employment that they could raise rates and knock down inflation. They haven't had a problem, but I think they're going to start having a problem keeping up.
Yeah. Well, it'll be interesting to see if Powell retains his job. And I say that not because I have anything in particular against him, but rather, does Trump have something against him?
He does. He'll be fired. Yeah. He'll be fired almost immediately, because Trump's going to ask him to be more aggressive with lowering rates. Trump, he doesn't care about inflation. I mean, he just wants growth. He wants the growth to look crazy, and he wants rates lower so that business can borrow. And he's a real estate guy, right? He wants low rates, so he's going to push that. And Powell's going to have to resist it because of his dual mandate, and he's going to see inflation moving up because of the tariffs and the deportations, and the lower taxes, and potentially stronger growth initially from those stimulants. And he's going to have to, at some point, stop lowering rates that they've been planning on doing.
Well, and the reality is, we're not going to see the effects of for a while. In other words, we may see immediate action, like you say. Powell may be let go, and other changes, certainly with his cabinet. But the impact on the economy, that's going to trickle in throughout much of 2025. So there could be more of a reaction in the private sector initially, based on what gets through. Although that's going to take a while, as we know, to actually trickle into the economy and have an impact.
Yeah, I mean, it could affect the market sooner since they tend to be a leading indicator.
Yeah.
But the economy itself, right, it's going to take a little time for that to trickle through for sure.
Yeah. So, Mike, let's move to our question. We have a gentleman, Sam Friedman, is writing in and asking basically about the difference between technical and fundamental analysis when it comes to buying and investing in stocks. Can you briefly describe the difference between the two?
Sure. So, Sam, fundamental analysis is what people tend to think of most of the time, and that's looking at the company's earnings, their profit margins, their strategy and plans for growth, and analyzing those things to say, okay, this is a good company, I want to hold it. The technical analysis is really just looking at most of the technical price actions, time price series data, as I refer to it. So it's price action, the volume that's moving in and out of that stock. And what you find is that the long-term fundamental value of a company does drive its price over the long term. And so it's good to look at that. But a lot of people tend to look at it and say, okay, this is a good stock based on its fundamentals. They buy it, and then it goes down for a year or a couple of years, and they abandon it. And the reality is, in the short term, the fundamentals have almost no play on where the stock ends up. It's all about emotion and sentiment in the market. And company could be growing strongly, but if people aren't interested in buying it, it's not going to go up. So you've got to follow, I believe, if you're looking at anything shorter term than a 5 to 10 year hold, you got to take a look at the technicals as well to give you an indication of whether you should be getting into a stock or pulling out.
So you think a combination of the two really is the best formula?
I think it's great. Yeah, absolutely. Unless you're buying something that you think you want to hold forever, in which case you might use the technicals just because you're looking for a buy opportunity it's sold off aggressively or something. But otherwise, you just want to buy that stock and hold on to it.
Yep. Good answer. Good insight. Thank you, Mike.
Sure.
And if you have questions that you would like our group to address, by all means, send it in, and we'll get you on the list. And here's how you do that.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says Send Us Your Questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Well, why don't we welcome our guest for the show, Rob Waring with Strategic Exit Advisors. And we'll learn a little bit about what Rob does and what his current thinking is. Welcome, Rob.
Jim, great to be here. Thanks. Good to see you.
So as an introduction,
Hi, Mike.
Can you provide just a really brief insight as to what you do? Who is Strategic Exit Advisors?
Yeah, I'd be happy to, Jim. Strategic Exit Advisors is an 18-year-old investment bank who works with entrepreneurs, founders, and families in the sale of their business. We've been doing this for, like I said, 18 years with these entrepreneurs. It's the biggest financial transactions of their lives, and we take them through a process to find them the best potential buyer for the company and to retain the legacy and really honor the business going forward.
Do you have a size business or businesses that you specialize in?
Yeah, we do. Most of the businesses that we work with are somewhere between 10 and 50 million in value. We'll work with companies that might be a little bit smaller than that, but that have, strong growth potential, that have all the indicators of businesses that are, have strong growth and would have interest in the market.
So Rob, how has the state of the economy impacted deal values and structures? And has there been any changes that you've seen leading into this presidential election we were talking about at the beginning of the show?
That's a great question, Mike. So the economy in general, I mean, when interest rates started to climb up, there were some, and inflation was going up. I think those economic indicators really impacted deals that are at larger sizes. We didn't find a whole lot of impact from a valuation perspective on the transactions that we work on. I would say there's not a lot of leverage that tends to go on the transactions that we're involved in. So the interest rates don't have a huge impact. The bigger impact was probably, I would say, in the structure of deals. Availability of capital was a bigger challenge. So getting access to capital, being able to put some debt on a deal was harder. So we were having to get a little more creative around structure. So that could be earnouts if a private equity group was involved. It could be a seller note. It could be your rollover equity. There's a variety of ways to handle that, but we didn't see overarching impacts on valuations.
What are some of the current trends, Rob, that you see happening and may continue to see into 2025?
Yeah, I would say the biggest trend that we are seeing right now is a result of the fact that private equity drives a lot of the lower middle market. So we sell to a lot of strategic buyers who are backed by private equity. Now, what private equity has done a very good job of over the last several years is raising capital. So they have a tremendous amount of capital. I think the last number I saw was $2.5 trillion of dry powder that private equity needs to deploy. Where they've struggled is deploying that capital. There haven't been enough good deals in market for them to deploy all of that capital and put it to work. And as you guys know, private equity groups have earnings targets, return targets for their LPs that they're trying to achieve. And it's very hard for them to achieve those if they don't quickly deploy that capital and get it to work. So the biggest trend that we have seen now, because there's not enough good deals in market, is that they're going direct to business owners. So they're reaching out to business owners. They're attempting to get them into LOIs. They're trying to get those deals achieved, get them across the finish line to deploy that capital. What we've seen is that's resulted in a lot of LOIs that have been produced that aren't that sturdy because they haven't been fully vetted. They haven't gone through a process. Some of the information that should get disclosed before an LOI is entered into hasn't been disclosed properly. It's just the dynamic that's been created, and it's been a big challenge.
What do you do, and how do you counsel companies that get unsolicited bids for their business? And do you see that a lot? Is that something that's common?
It's I would say our clients over the last several years, 75 to 80% of our clients have come to us in, I would say, one of three states. They've either been under an LOI, they were trying to do it themselves, and the deal fell apart. They've been approached by buyers who want to have a conversation about acquiring them, and they just don't know, what should I give them when? How should I handle this conversation? What's my company worth? And then the third one is they have an LOI in hand that they haven't signed yet. And so that LOI is not something that tends to be really well vetted. So those are the majority of our clients. So what we always tell business owners is, look, if you're having conversations about selling your company, you're in a process. The question is, whose process is it? If a buyer approached you, it's their process. And if you're putting together an organized process of going out and contacting multiple buyers at the same time, it's your process. And the party that owns the process gets to make up the rules.
It's interesting. I remember back in the 1990s, and the Glazer family that had, I'm blanking on what their business was. Now they've got a number of sports teams and things they own, but they faxed over a like $5 billion offer to buy Excite. He sent it by fax. It wasn't even a phone call. And the other guy on the other end of that fax, it's just some guy walking into the office pulling it off there goes, we're offering $5 billion to buy your business. And it's like, what? And it was real. It was a real offer. They didn't accept it, but yeah. The offers come all sorts of ways.
It's funny you say that. I mean, and that is the thing. It's not that there's anything nefarious going on out there. I mean, these folks are desperate to deploy the capital, and so they need more deal flow. They need more quality businesses. They're talking to owners who aren't really sophisticated in, how do I get to a recast EBITDA? Like, well, what are normalized earnings? What do those look like? What is the information that I should be providing at the time, getting into an LOI? Because the biggest challenge is, once you sign an LOI, you go under exclusivity. you get to start quality of earnings. And if your numbers don't hold up, the numbers that you presented or provided, if those don't hold up, I mean, the LOI wasn't really worth the paper it was printed on. You can go ahead and tear it up because your deal is going to change. So our job as a firm and how we help clients is making sure that before that LOI gets signed, that everything that needs to get disclosed, a realistic presentation of the numbers of the business, talking about the narrative and the story of the business and of the numbers and where's the business going. Those are all important pieces of the equation when it comes to valuing a business. So we want to make sure that that all gets out in front of an assigned LOI.
Rob, you had mentioned that deal a couple times, that deal flow is a little light. That's my word, not your word. But in other words, it's almost like there's more demand than there is supply. Two questions. One is why is that? And two, what would have to happen to make that change so it comes maybe more into equilibrium?
Yeah, it's a really good question. We definitely saw a slowdown in deal volume early 2024. It seems to be picking back up at this point. I think there was a lot of hesitation about going to market with the current state of the economy, with interest rates where they were, even though they weren't really impacting valuations on transactions of our size. It was the perception was now is not a good time. Certainly, inflation was playing a role. A lot of clients are seeing, there's some earnings erosion. It's hard to maintain some of the margins if they're not able to raise their prices as quickly as their costs are going up. So, you don't want to take a company out to market. It's not the optimal time to sell if you're looking at that kind of earnings erosion.
Mm-hmm.
So how far in advance should somebody start preparing for a sale of their business?
It's funny, Mike. I get that question a lot. My answer to that is, and I hate to distill it down to something that is so simplistic, but I think everybody can relate to it. If you've ever bought and sold a home, you love your home the most on the day that you bought it and on the day that you sold it. And you love it the most on the day that you sold it because you fix all the little things in your home that had been broken. The missing piece of molding on the door frame, whatever it might be, the leak in the faucet. And it's, when you get that house ready to put it on the market, you look around at that house and you say, this is a beautiful house. I wish I had lived here for the last decade. So the same is true with your business. Get it ready now because your business will probably grow quicker. It'll probably be more profitable because you're addressing all these little issues in the business. You may like the business so much you decide not to sell it. Maybe you hire somebody to run it. Maybe you keep it in the family for a long time. All of those are good outcomes. But from a planning perspective, my favorite expression is men make plans and God laughs. We don't find that business owners tend to say, okay, I'm going to start planning now and I'm going to sell it in 5 years. That's never the way it works. Right. It's usually something drives that decision. And it could be a buyer approaching and making you an offer or starting that sort of process going. It could be a health problem. It could be something happens in the family. Your kids say, we don't want the company. Whatever it is, it's often incident driven as opposed to being a decision of just pure timing.
Are there sectors, Rob, that either your company, Strategic Exit, specializes in, and are there sectors that are more active than others? Manufacturing, distribution, construction are a few that come to mind.
Yeah, so we do a fair amount. We work across a broad variety of sectors. We work primarily, though, with manufacturing, value-added distribution, and B2B services. Services businesses are very hot. As businesses that have strong fundamentals, they're all very attractive. But when you look at, for an example, like a company that does calibration services, that is the type of thing that when you look at the market and when you look at the customers, it's not something they can choose not to do. If you go in and you provide calibration services to, say, a lab equipment in the life science industry, they have to get those calibrations on a regular basis. They can't choose to not buy that. They may choose to not buy it from you, but they're not going to choose to not buy that because it's regulated and it's required. So those businesses where that dynamic is at play are the highest of value and certainly the most attractive.
So we that kind of answers the question I was going to ask is the attributes of the best companies. And I always thought of the companies that seemed to be in demand were ones that had some sort of annuity stream,
Yes.
a revenue stream that was recurring revenue. Is that still the case, or is it more just it's in demand and it might not be recurring that they lock into, but it's just a high demand industry.
Yeah, I mean, recurring revenues are certainly the highest valued revenues by buyers. Then you have to look at things like what is the churn on the customer base, but if it's something that could be shut off by your customer, something they could choose not to do, that's at more risk than something that is mandated, something that they have to do. They know it's never going to go away. That revenue is never going to disappear. So, but yes, if you had recurring revenue in a regulated industry, that's sort of the best of both worlds.
Rob, how often do you see companies and clients that have international, either international clients or business centers in, abroad?
Most of our clients are U.S. based. We have worked with a few international clients. What we have worked with a lot is international buyers. We've worked a lot with international buyers, primarily European buyers, who have an interest in the U.S. market. And they're typically providing similar services or products in their territories, but they want to break into the U.S. market. They want to have a foothold here. So we have found a lot of interest from European buyers in particular, and occasionally from Asia. We've never dealt with a buyer from Africa, real far down in our process. Not that we haven't had them in the process. So that's where we see a lot of interest, but the majority of our clients are domestic.
How about any deal where it goes from one generation to another, although that bridging that gap can be quite challenging? Do you get involved in
the succession?
Yeah.
Yeah, we don't. When we started the firm, we started to do exit planning, which is exit planning is a process which we believe deeply in. We actually started doing exit planning when we started the firm in 2007. We don't do exit planning any longer, but we are active in the exit planning community. And really an exit planning professional would be better suited along with the other advisors that would need to get involved in that for succession planning.
I was going to ask, do you see much change when the dollar is strong or the dollar is weak if you have these foreign buyers?
I don't think we've seen a huge change in the interest from international buyers, because it doesn't tend to be monetarily driven. It's usually a strategic buyer who has a strategic purpose. So the interest really is, if you've got a strong customer base in the U.S. and you have an international buyer who sees the U.S. as a lucrative market, the strength of the dollar is not a huge driver in that transaction at the size deals that we work on.
Yeah. Hey, Rob, we've come to the end of our show, and thanks very much for your insight, and let's hope for a healthy and productive, active business climate into 2025. I think, all rising tide lifts all boats sort of thing. And thank you for tuning into the show. Hope you picked up a few things. And our next guest is Elaine Pasqua. She's with the National Speakers Association, and they have a tagline, be a better speaker, build a better business. So certainly nothing wrong with that as a motto. In the meantime, thank you for listening.
Great. Thanks, Jim. Thanks, Mike.